example, and Macquarie in Western Australia is building a 20 gigawatt hydrogen generation facility,
wow.
Which is using wind and solar. So where you've got good solar or good wind, you know, if you have a large enough contract, you can make the numbers work, particularly with some of the new electrolysis kit that's coming through from China, which also reduces it. So this is going to be a fast-changing space. And
we need hydrogen.
Fewer energy actors in South Africa, it could be an opportunity.
Yeah. And we need hydrogen because it's it helps support the platinum sector that will be in decline with the phase out of autocatalytic converters. So
right,
it works for us.
That's a very interesting point. I'm going to mention a little later today the mining sector and transition minerals. So we've started work with Chile on their taxonomy work, and we've encouraged them to bring together a committee to look at critically important minerals for the transition, such as lithium and cobalt.
Yeah.
And I'm suggesting to them, they haven't quite bitten yet, but I'm suggesting to them that they approach some of the other key mining countries to be involved in that process to make it an international collaboration up front.
Yeah.
Clearly, that's going to be Canada and South Africa and possibly Australia, although I'm not so sure the government's receptive in Australia.
Yeah.
Just to let you that will be, sorry, Steve, that will be letting people in now.
Okay, we'll mute ourselves till we're ready to go. Thanks.
Okay. Okay, that's good. Okay. Okay. Good afternoon, everybody. Welcome to this event on a green recovery and a conversation about stimulating South Africa's post-COVID economy and ensuring our competitiveness is where we need it to be. We are just going to give the last few people who are about to join the chat a few minutes just to get themselves settled, and thereafter we'll begin our conversation. So I'll just perhaps start with some housekeeping rules for the time being and repeat them as people enter. Kindly mute yourselves just to make sure that the event runs smoothly and we don't hear any additional noises. And also please switch off your camera. We will make sure that only the speakers will have their cameras on when speaking, just to make sure that we don't have any bandwidth issues. I see that there's still a few people joining us, so please give us a minute or so and then we'll be able to go ahead with the program. Mm-hmm. Mm-hmm. Yeah. Okay. I think we've got quite a fair number of people have already joined us. I'm sure the rest will join us as we proceed. I'd like to welcome you once again to this event that we're hosting as the NBI in partnership with the National Treasury, Carbon Trust and the IFC. Just also to mention that this work that we will be talking about today, so that's the development of a green finance taxonomy for South Africa, has been sponsored by SECO as well as CEDA. So we are quite grateful to their support in getting this work done. I'm going to hand over to Steve Nichols from the NBI, who heads up our work on environment, to give us a brief welcome before we really have this wonderful discussion with a range of experts providing some really valuable insights. Steve, I'm going to ask you, please, if you're ready to proceed with the welcome, and then we'll be able to go ahead with the rest of the program. Thank you. Mm-hmm.
Hi, everybody, and yeah, welcome to everybody who's joined. Thank you. It's a really good turnout, so we appreciate that. Yeah, so today is an exciting day for us, partly because I've been looking forward to having this conversation for some time, but also because we are launching this really interesting and important project and inviting all of you to comment and join us in this project, but also then, just to hear about more of what we're doing. So I wanted to do a quick introduction. Rutameti, if I can have the screen, then I will just share. Right.
Thanks,
yeah,
Steve.
so this is, thank you. So yeah, this is kind of the context to the conversation and the idea that we're going to need to stimulate our economy in order to recover from COVID, but to give that a bit of economic context. These are the commodities that make up our balance of trade. So our top 6 exports are platinum group metals, coal, iron ore, gold, ferroalloy, and the internal combustion engine. Probably not a portfolio that you would choose if you were looking for a competitive economy in a carbon neutral or low carbon future. And the balance of payments and balance of trade is really important because we use that foreign currency to buy things like liquid fuels that, at least in the medium term, we use to run our economy, and on a cyclical basis, things like food as well. But also, it helps us manage debt repayments, and obviously debt as a percentage of GDP is a big concern for us post-COVID, and in particular the amount of borrowing that we would have to do. And so we have to transition our economy quite significantly. And if we look at how countries have invested in their economies over time, we can see that these are a percentage of stimulus packages that were green post-2009. And so some countries, the EU, one of our major trading partners, Britain, Germany, all big trading partners, have been investing in green for a decade. And so structurally, their economy is better suited to a low carbon future and therefore more competitive than ours. And as we think about the COVID context, so, South Africa entered the COVID crisis already in recession, already having a low national fiscal space, 62% debt to GDP ratio, 29% unemployment, 50% youth unemployment, rating agencies already predicting negative growth, and medium-term debt to GDP ratio trending to 90%. We saw from the finance minister's speech a few weeks ago that we're already in the mid-80s, and we expect that our debt to GDP ratio could well go above 100% in the next 12 to 18 months. And so we have this very kind of difficult product portfolio. We have a carbon-intensive economy that's very trade exposed, and this quite difficult economic situation to begin with. And so we as a nation, public and private sector investors, but with particular role for government to lead in many of these areas, we have to work out how do we stimulate the economy in the medium term, managing things like SMME and household liquidity, but also not compromising our long-term competitiveness. And given the state of many of our industries and many of our and our government balance sheet, it's quite likely that green stimulus is going to be one of the better options for us to think about. And if we miss that boat again, we see from stimulus packages being mooted by countries around the world for the post-COVID disaster, we see the same kind of language coming out of those same countries, green investment, ramping up investment in renewable energies and other long-term green players. And so that's the context we find ourselves. And by taking that green stimulus opportunity, there are 4 key advantages that we can talk about. We'll have access to additional funding. So there are dedicated climate funds out there and green funds that we could access, and those total roughly $83 billion US. We can potentially get cheaper capital. I'd be very interested to hear from Sean and from others about the feasibility of that. Investing in low carbon and green options creates immediate direct jobs. And of course, a key one is we mitigate against some of the about 1.8 trillion rand of transition risk that we are exposed to as an economy. And if we look at the institutions and the countries that are offering that particular 83 billion, we see that they're the same institutions that we borrow traditionally from: the World Bank, IMF, IFC, African Development Bank, and the same kinds of countries that we trade with and that we rely on. And so we would expect this kind of green stimulus conversation to creep into our traditional lending. And so what we need to do is structure that conversation. How do we guide the financial services sector and project developers to think about what is green, what do we intend to focus on, and hence the opportunity of this green taxonomy conversation within the green stimulus conversation. And just in case you thought it wasn't relevant, I thought I would pop up the headline of the Financial Times today, which is all about Christine Lagarde talking about the European Central Bank's bond purchasing strategy, which is going to be focused on green bonds. So again, an opportunity to find buyers for these bonds, as long as we can frame the conversation in the right way. And so today we are here to talk about that a little bit more, learn from our local and international colleagues, and then to talk specifically about green investment taxonomy and the role of green finance in South Africa's transition. So with that brief welcome, I hand back to you, Rutameti.
Okay, thank you very much, Steve. Yeah, that was a very incisive kind of introduction on such a weighty topic. I'm just going to run through the rest of the agenda very quickly, just to give you a sense of what we'll be doing next and who's coming up. And also just to mention that the presentation, the presentations that will be given throughout this event, as well as a recording of the event, will be made available afterwards. So you'll always have that as a reference. We will now be going into a series of just talks and insights from some of the experts. So starting off with National Treasury, I think really the most relevant body to start framing this conversation that Steve had mentioned. Sarah McPhail from National Treasury will be presenting on the technical paper that was produced by National Treasury on financing a sustainable economy. Thereafter, we will get insights on the global context for a green stimulus from Sean Kidney, who's the CEO of the Climate Bonds Initiatives. And thereafter, we have three experts who will just give us their insights from their different perspectives. I'm coming from quite a wide range of kind of aspects and perspectives in the financial sector. So we've got Shamila Ibrahim, who's the Chief Sustainability Officer at the JSE. And we'll also have insights from Jolie Mokorosi, who's an independent retirement fund professional. And she's representing the Batsesa Asset Owners Forum. And we'll also get some great insights from Berit Lawrenson from the IFC. And thereafter, we've provided enough time as well to get plenty of questions and insights from all of you who are participating. And I'd also like to say at this point that to please use the chat function to just provide us with your questions, and we'll be able to direct them accordingly. And with that said, I will hand over to Sarah to give us some insights into the work that National Treasury has been doing, and really the context of the green finance taxonomy that's being developed and hopefully will form part of this stimulus for our economy. With that, Sarah, can you please go ahead and take the stage?
Great, thanks Rutameti. Can you see my slides? So good afternoon, everyone, and great to have you all here. I see there are a lot of familiar names, and I must apologize if some of you have seen these slides before. But I've got just 5 slides to give some context and substance to the technical paper that National Treasury released in May, entitled Financing a Sustainable Economy. So the paper was released by the Financial Sector Policy Unit, wherein I am a director, and it was specifically under the financial stability mandate of Treasury, which is to protect the economy and the citizens from shocks to the financial system. Whilst the paper focuses on climate risk to the financial services sector, it makes broad recommendations to ensure that all financial institutions embed and improve their capabilities for identifying, managing, and disclosing environmental and social risks in their portfolios. We encourage the uptake of leading practice and strengthening the regulatory framework. Specifically, during this time, we see it, the paper as an enabling framework to unlock economic opportunities as the country adapts not only to COVID, but builds resilience in response to climate change and transitions to a low carbon economy. There's a link to the paper for those who haven't seen it yet on our website. The paper takes a very broad and holistic approach to sustainable finance, which encompasses social, green, and climate finance, and the initial focus is on climate risks. It's a technical paper in its context, and it's complementary to various other broader policy and related initiatives, both within Treasury, which I've listed on the left-hand side, and government policies and frameworks that are listed on the right-hand side. Most of these are led by Department of Environmental Affairs, and essentially the paper was developed over 3 years, and during that time, you know, globally the Paris Agreement targets were set. They were ratified by South Africa. The Financial Stability Board recommendations on the Task Force for Climate-Related Financial Disclosures were released. We implemented locally the Twin Peaks regulations through the Prudential Authority at the Reserve Bank, as well as the Financial Services Conduct Authority. And now, of course, we're in the midst of the COVID pandemic. So we're acutely aware of both the risks to the financial sector, the need for financial stability, as well as a very unique opportunity to build back better through green and social reforms. We acknowledge that sustainable finance is an evolving area. It's an emergent global practice, and our technical paper is really just the first formal steps to develop a South African approach and an enabling framework for investors. The definition we proposed in the paper is that sustainable finance encompasses financial models, products, markets, and ethical practices to deliver resilience and long-term value in each of the economic, environmental, and social aspects, thereby contributing to the delivery of the Sustainable Development Goals and climate resilience. The paper was developed by a working group which was chaired by Treasury with members from various financial sector industry associations, both the Banking Association, Insurance, and others, as well as the JSE and the BATSITA, the Council for Retirement Funds. The paper has recommendations that covers the whole financial sector: banks, retirement funds, capital markets, collective investment schemes, insurance, private equity, as well as venture capital. And we're using the same stakeholder approach, and working groups have been even expanded to include the local DFIs as well as DPME to take forward the recommendations in the draft paper. This is an acknowledgement that a sustainable finance narrative already exists quite strongly in South Africa, as do networks of coordination and cooperation. So we're really building on what is already there and not recreating or changing. So the paper has general recommendations, and these form the basis of our initial focus areas. The first one is to develop a green taxonomy, which NBI and Carbon Trust are working with us to do, as well as a governance framework for that taxonomy so it can be adapted and evolved in the future. A taxonomy, for those who are not clear on this word, is a fancy word for a classification system. It identifies the activities, the assets, and the project categories that will deliver on key green objectives with reference to identified thresholds or targets. And it should ultimately incentivize capital to flow towards these green activities. Sustainable finance instruments, the most common of which are green and social bonds, but there's a much broader universe of sustainable finance instruments, and we'll be reviewing the applicability in South Africa as well as their appetite, and recommending an enabling environment for sustainable finance to grow. The third recommendation and focus area is on disclosure as per the Task Force on Climate Financial Disclosures. And this is really to establish a baseline across the sectors. So understanding that a lot of banks are disclosing already as per TCFD, but to develop kind of a minimum disclosure requirements, to engage the regulators to identify what is relevant for South Africa context, and to monitor adoption and application over time. The next one is to develop a benchmark climate risk scenario for use in stress tests, and this will start with insurance and banks, and this really speaks to our financial stability mandates to understand what risks there are across the sectors as a whole, using the same assumptions and the same base scenario and different stress tests thereafter. The next one is to build sector capacity, and this will be to develop training, raise awareness of the various work that's coming from the paper, both for the financial sector as well as the broader environmental sector and government as well. So as we develop a green taxonomy, as we develop disclosure guidelines and a climate risk scenario, we'll look at the capacity and training that's needed for people to be able to use these tools. And then an action plan is really just putting all these focus areas into a kind of document, similarly that's been produced in other countries, that everyone across government and the sector can buy into and set initial targets and timelines. So focusing on the green taxonomy today, what we're calling a version 1 green taxonomy will really look at the definitions and principles of what green is and what thematic areas we want to prioritize from a South African economy context, the screening criteria, and the different dimensions. The governance structure will then look at who is the custodian of the taxonomy and the process for adaptation, iteration, and refinement. So we could over time include a brown taxonomy, a social taxonomy, an SDG taxonomy, for example, and a governance structure will allow us to do this. Ultimately, it's going to govern what is recognized as green in a credible, consistent, and dynamic way for South Africa. It's a coordination tool, matching activities on the demand side and the flow of necessary finance for investments on the supply side. We will use international taxonomies and also consider local context, both South African policy and transition pathways. And Steve will go a bit more details into the consultations and timelines, but we hope to have the version 1 taxonomy by the end of this calendar year and then have a broader consultation. So within 12 months, we have a taxonomy that's been fully consulted and agreed upon. So lastly, before I hand over back to Steve, I think in defining what projects and sectors will qualify as green and sustainable as well as inclusive, we hope to unlock funding, create jobs and economic growth. These are all obviously within the constraints of our fiscal and debt frameworks from a government perspective. And that's why we hope that the paper enables greater private sector investments. We see the organizations to take their signal from the technical paper on what their role may be in the sustainable finance narrative and work that is happening within South Africa. We hope to partner with different institutions to take forward these recommendations. Thank you very much.
Thank you very much, Sarah, for that, I think, really concise but packed kind of presentation on what's happening on the stage. And I think, again, to referring to the length of the presentation, it doesn't match really the significance of the work that's underway. I think it's quite a momentous kind of occasion, and really we've come a long way in this area. So thank you very much for that presentation. Before we go on to Sean's presentation, who'll be giving us a kind of a great understanding of what's happening globally, and maybe also provide seeds for us to embed in our own work. I'm just going to alert you to some of the other things that will be coming up that I hadn't mentioned previously, and that's really about more detailed work that we are doing with Carbon Trust and the IFC and National Treasury, and Sarah has alluded to it. And that's just going into a bit more detail in terms of what we are actually doing and providing you with the information you need to participate and to contribute to this work. So with that, Steve, I'm going to allow you to please go ahead and just give us a bit more detail on the actual project itself. Thank you.
Yeah, thanks everybody. And I mean, just to make sort of thank Treasury for their leadership on this. I mean, I think Sarah makes the point that, you know, climate change and environmental issues are economic issues. They're about financial stability. They're about how we collaborate as public and private investors in order to create a more competitive economy. And the green finance taxonomy is a really important first step in that process. So I wanted to share with you the work that we've been doing with the Carbon Trust, and really just give you a highlight. What are we after here? So Sarah's already talked about this. A taxonomy provides a common language. It's an important part in how we set a vision and common goals, but it's a classification tool that creates some market certainty around what ought to be in and what ought not to be. That's of course at a very simple level, and there's some more complicated depths to that, and I'm going to run through some of those thoughts quite quickly now. But really, we're going to produce two outputs out of this program. One is the governance mechanism. How do we update it? When do we update it? What triggers it? Who's responsible? Who's accountable? And that's important because obviously these systems are living systems. New technologies come online, new ways of thinking come online, and so we have to be able to update the system as we go. And so a credible, centrally managed system is quite an important part of the process. In parallel, however, we're going to produce a first draft of the taxonomy, which will have at least best practice up until now for a certain set of categories. And also to make the point that the investment taxonomy exists in a context, and there are a whole bunch of other things that are needed in order to make it effective. We need to be talking about reporting frameworks and indicators, how we assure it, how this aligns with TCFD, ESG risk management and general assessments, but all of that is happening in the context of international best practice, the expectation of markets, and also the national policy landscape. So it's an important piece of the overall puzzle, but obviously not the only piece. And globally, there are quite a range of different taxonomies that people have been thinking about and slightly different approaches. And they all, though, are really rooted in four fundamental approaches. And they range from how you deal with the taxonomy as something that's principle-based, that delivers more than just a catalog, but also guidance and standards, all the way to the other side of the spectrum, which really just creates a set of categories that would be considered green, and then the in-between would provide a lot more detail on those thematic categories, getting down to product, asset type listings. And so these are the kinds of decisions that we have to go through, and Treasury are doing this work, as Sarah mentioned, through a working group. So we have a working group of industry experts that are helping guide this program. And really these six are the ones that we are sort of benchmarking South Africa's development against. We think it captures the four clear approaches and some innovations in the PBOK and the Mongolian approach. And so this is kind of the breakdown of how we see these things differ. So we talk about the depth of a taxonomy. And so you can go from the definitions and the principles and objectives of what you're trying to achieve from a green economy and economic transition, and then provide that with much more detail around listing the themes and the activities, and then support that with technical guidance. So within a theme or an activity, what counts and what doesn't, and then also provide user guidance. And users might have slightly different objectives out of a taxonomy. So for example, government might want to be able to understand how it should impact policy and economic processes in general, whereas a private equity investor might want specific asset classes that they can then consider green. And all of this has to fit into a broader context and standard setting process. And so the different taxonomies that I mentioned, the 6 that we could benchmark against, go quite deep for different areas. So CBI, and unfortunately Sean will give us more detail on that, CBI have gone all the way down to technical standards, and the EU have gone all the way down across the whole spectrum. And then some of the other approaches that are more catalog driven really just focus on those kind of middle bits, a clear set of objectives and a strong listing. And so obviously the decisions that we make here will impact both the budget for how it gets done, but also its potential breadth of usability and the speed at which it can get done. So the first set of decisions we need to make as a broader societal group is how deep do we go? But also you'll see that it talks about 6 areas, 2 areas, 1 area. And so across the spectrum of green, you can get into quite a significant amount of detail for different areas within green. So all of the taxonomies that we've looked at deal with climate change mitigation, and most of them deal with adaptation. But then of course you've got things like sustainable water use, both freshwater and marine. You've got waste and circularity issues, you've got ecosystem restoration and resilience kinds of issues, and you've got pollution prevention issues and maybe some others as well. And so you can see for many of the ones that are sort of theme-based or catalog-based, they tend to have done a more deep analysis across all of the systems because they don't have the upfront principal work. And then for places like CBI and EU, finance taxonomy, they have started out looking at climate change, and certainly in the case of the EU, intend to drill deeper into some of these other areas. And again, you can get incredibly detailed within an area, and you can also then expand across all areas. So again, one of the decisions that we have to make, and why the governance components of the project is so important, is we may in this first year do the detail for climate change, mitigation and adaptation, maybe one other category, or we may do the detail for all of them. We're going to have to work out how wide we go. So there's the depth and then also the width. And these are kinds of the sector areas that we see across all of the initiatives, and relative overlap. But just to give you a sense of the kinds of things that are being focused on from a sectoral approach. So we've started to frame some of these and trying to break down some of those categories into specific buckets, and we'll continue to do that. But just to give you an opportunity to see what it might start to look like towards the end. But these are the kinds of things that we're going to want to consult with a wide range of stakeholders. And one of the key objectives of today is to make you aware of the work that we're doing, and invite you to join us in talking about these concepts and helping us to structure what the ultimate taxonomy looks like. And there are 4 kind of core questions that we're kind of coming up with so far. Is, do we benchmark this taxonomy against local policy or international best practice? And there are pros and cons to either one. If we benchmark against local policy, that local policy might not be ambitious enough to attract foreign capital who may be looking for more ambitious opportunities, but administratively it's more certain and more functional. Or we could go for all international best practice across all of the depth and the width, which would make it far more onerous, but also have a higher level of credibility potentially in the minds of some international investors. Do we apply the classification system at an asset level or a value chain level? So for example, do we say that renewable energy is green and therefore all of the value chain and production components that relate to renewable energy are green, or do we just say building wind turbines are green? So getting to that level of detail is also important. A massive challenge in the South African context is what is green? And so you have things that are classically green, that are easy to understand, that are certain, and then you have things that might be transition assets that contribute to the transitioning of the economy to something that is green in the future, but isn't necessarily green in itself. And then, of course, in our context, you have the additional complication social components, employment, inequality, and lifting people out of poverty. And so how do we factor in all of these things? Because obviously it's more functional and easier to just focus on green and be very strict about what we consider to be green and what we don't. But these other components are also really critical in how we think about transitioning. And then the last area to think about is how much do we customize what's already available? And so we can take standards from the EU taxonomy, for example, without much modification in the South African context, or in some cases we may have to develop our own standards because of our unique context. So these are the things that we're going to have to work through as we develop the project over the next 6 to 12 months. And certainly there'll be many other questions, but these are kind of the 4 questions that define the kind of scope and breadth of the challenge, but also help provide some strong guidance on what to do next. So just to give you a sense of how this is, the process is structured. So we're in this first phase here, developing the governance frameworks and the taxonomy itself with technical contributions and reviews from experts. As I mentioned, this is a first step in inviting you to be part of that process and working through the Treasury Steering Committee on taxonomy development. And that's going to be pretty iterative. We expect that to take several months. In parallel, making sure we're tracking what's happening in the development of regulation and international standards, and also doing a larger awareness campaign, making sure that those of you involved in financial sector and project development and green stimulus are aware of this project and are able to participate. And then the first draft will be the output of that process, as well as the governance mechanism that allows us to keep this as part of our development framework as a whole. And so just to highlight the opportunities, we are going to be having 2 major workshops in the next 4 weeks. The first one in the week of the 27th of July with policymakers and general financial users. And then the week after that, focusing down on financial users as a particular beneficiary of the taxonomy. And all the time doing critical one-on-one engagements. So to kind of summarize my presentation, this is a taxonomy can be an incredibly useful part of how we structure finance and how we direct finance, but also is something that's quite complicated and is going to require quite a lot of deep thought. And we want to develop this in a way that it is useful to you, the financial community, as users. And so we want to be able to do this in a very collaborative way. And there will be lots of opportunities to engage, but these are the first 2. When we send out the summary of this event, we will also just send a link that allows you to register your interest in being part of one of these workshops. And so, so please treat this as an invitation to join us. We're looking forward to some of your insights later on today as you drop your questions in the chat. And certainly we're looking forward to hearing the insights of the people on the discussion panel and Sean, who is up next. So thank you. I know we're pressured for time, so I will hand back to Rutameti.
Thank you very much for that, Steve, and just detailing the approach that we'll be taking and emphasizing once again that this is a collaborative approach. So we definitely need all the stakeholders involved in developing what should be a nationally appropriate and relevant green finance taxonomy, and also calling out in particular to the private sector to I think take up that leadership as well in contributing to broader national efforts to respond to climate change and just the broader range of environmental risks that we're facing. I just wanted to highlight very quickly as we proceed, just to acknowledge again the support that this work is receiving through the IFC, their Green Bond Development Program, and that is work that's been supported by the Swiss State Secretariat for Economic Affairs, that's SECO, sorry, and CEDA, the Swiss International Development Cooperation Agency. And this project is also benefiting from the broader support of the IFC facilitated sustainable banking network. So just to acknowledge that support in what is quite a big and challenging undertaking, and we're right at the beginning of this work. And to just steal what I've seen in the chat box from one of the participants, just mentioning that as the world and in general, so different countries are, I think, understanding and exploring the benefits of putting climate change and that green agenda at the center of their social and development strategies. There really is a wonderful opportunity now to take to heart some of the insights and experiences that Sean Kidney will be sharing with us. He's got vast experience working in this area, and I think in his leadership role at the climate initiatives, Climate Bonds Initiative. So Sean, if you're ready, I think the group is really excited to hear about what's happening around the world and to get your specific insights on this work. And I'm just going to project your presentation and
sure, let me get going. You've heard a bit about how we're in the midst of a crisis while Reg is getting the slides up. You know, I want to just stress a couple of things about the implications of that. First, we're discovering how fragile our economies are to a crisis of this kind, especially a global crisis, which has been extraordinarily interesting for us all. And Steve's presentation was example. I have to say, it's been fantastic to see the Treasury paper on sustainable finance appear in the middle of this. It really made my week. It's a great paper. I want to say, Sarah and team, really, really fantastically done. And this is this kind of idea that in the midst of this crisis, we need to be thinking about the future we want to have, not looking at the past for guidance, I think is exemplified in this paper and exemplified in the policy discussion that's underway in many corners of the world. In fact, there's really only a couple of corners of the world where it's not going in this direction. And one of them is in some crazy house in Washington, DC. But in Europe, we have a very strong discussion now about building back better. It's a dominant theme. We have this happening in states in the US, like in California or New York. In Brazil, at a ministerial level, we have this. We've signed MOUs recently with the Minister of Infrastructure, the Ministry of Agriculture, to issue green bonds, certified climate bonds, in fact, as part of their strategy of promoting sustainable finance and attracting investors into that. In China, there's been a hell of a lot of news about some coal-fired power plants being restarted in the provinces. But I'm going to tell you the central government is working hard to stop that in the same way that you see this joust between states and feds in the US in a different direction. And in fact, in the new infrastructure investment plan that the Chinese government has announced is a green one. 59% of the capital they're going to be investing is actually in electric vehicles, which has profound implications for the oil and gas sector, oil sector especially around the world, because China's the biggest car market. If China's successful in going electric, you're going to see a drop-off in oil demand that's extraordinary. And people have to start getting used to this is going to happen now. And that's a feature of the recovery investments on the part of the Chinese government. So there's a very interesting discussion going on around the world. There's something else about this. The scientists have told us very clearly that this particular pathogen, COVID-19, has come about of species of pathogens jumping between species in environmentally degraded areas of southern China. In the same way, the MERS virus was pathogens jumping between species of stressed bats in Egypt and created the MERS virus. What people forget is that the International Panel of Climate Change has been predicting this for the last 25 years. They've been saying that the 21st century will be characterized by a series of pandemics as a result of degradation of our environment and our ecosystems. We won't experience climate change, a slowly rising sea level on the Durban waterfront. We will experience this as crazy storms that come and then go and then come again. Typhoons in Asia are expected to be 2 to 3 times the current intensity. We will experience as flood and fire, like Australia, where I was at Christmas, the biggest fires ever in history, recorded history, that we've seen. And we will experience this as pandemics. This is the first. We're kind of lucky in this pandemic, I have to say, that the mortality rate is only 1%. Not a great thing to say for people who've lost loved ones, but I'm going to tell you, for the world, if it had been SARS, which had been so successful at going global, we would have seen a 20% mortality rate. And certainly the flu at the end of World War I had a higher mortality rate than what we're experiencing now with COVID-19. So I hate to say it, but we're kind of lucky. We need to understand that this is going to happen again. We're already at 1.4 degrees Celsius warming. We're supposed to limit global warming according to the Paris Agreement at 1.5 Celsius. We know that's not going to happen now. The IPCC said to minimize the kind of shocks to our economies going forward, including pandemics, we need to get emissions down 50% in 10 years globally. This is the official IPCC 1.5 degree target from 2018 report. And the European Union is currently in the process of agreeing on that as a target. It's already agreed to net zero by 2050, as have many economies. The Japanese parliament is debating this at the moment, for example, Korea, et cetera, et cetera, et cetera. So we're not talking about a slow decline to 2050. The 10% cut by 2030 means we've got to get a sharp decline and then evening out. In fact, we have to drop emissions on average 7.6% per annum from now on to have a fighting chance of avoiding the kind of climate change that we do not want our children to be living in. This is the kind of climate change that we won't see the impacts of a pandemic. We will see a third to half the world's population going, most likely. This is a risk, it's a probability, but it's a very high risk, according to the climate scientists we speak to. So we're on a race to avert that. So in the midst of this crisis that we're experiencing now, not only have we got to deal with the fact that we're in crisis, that we have to get people back to work. Well, first we have to deal with people that are getting sick. Then we have to get people back to work. We have to then build our economy back better so that we can inoculate against future crises, which is where shifting our economies to green is. This is the global discussion underway now. I came off a webinar early this morning with ministries of finance all around ASEAN and central banks. Exactly the same conversation. Also exactly the same conversation because there's a question about how to raise capital to do this. How do we do this? We are in crazy debt times. Treasuries are reporting that their fundraising needs this year are 4 to 5 times higher than what they thought they were going to be everywhere. We're breaking through lots of barriers. We are lucky. Global interest rates are at historic lows. Admittedly, it varies from market to market, but in terms of reference rates in Europe, in the US, in Japan, and in China, actually, where they're holding still, they're still higher than those other markets. So that gives us something to work with. At a time when we have to invest some 90 trillion to shift to low carbon economies and to deal with the recovery and resilience, interest rates are very low and look like they're going to stay low for a while. So there's something we can work with. But we do need to understand what we're doing here. It's not just the one-time crisis. Folks, this will happen again. And everything we do to recover from this has got to bear that in mind. It's not a one-off recovery. It's preparing us. Now that means that, if you like, the idea of recovery isn't just stimulation. It's also about recovery into resilience. The European Commission has called its recovery fund the Recovery and Resilience Fund, 540 billion euros, which, by the way, is expected to issue green bonds to finance that fund. And they'll be looking at what that means for the health sector. How do we ensure that investments in the health sector are consistent with making the health sector ready for the next crises? In East Asia, after the SARS epidemic, many of the health systems built whole wings, they call them fever wards, to hospitals that were mothballed until the next one came along. And sure enough, they were able to open them up. They were already there in January and February when the epidemic, the now pandemic, started hitting. That gave them a lead on the West, who had no idea what they were doing and weren't even testing temperatures at airports, which Hong Kong's been doing continuously since SARS. So learnings from those, establishing systems in the health sector are going to be critical. But that also applies to economic recovery. and automatic stabilizers. You know, we learned in the 1930s that bringing in unemployment insurance in the US turned out to be a great automatic stabilizer. When a recession comes in, it kicks in, it provides a little bit of stimulus to reflate the economy without having to go to Parliament or Congress and deal with short-term politics. We're going to need more of these now in terms of the kind of lessons we're learning out of this. So that's the background to it. I, of course, want to get to the next part of it, which is bonds, because this has been the origin of this taxonomy discussion. We created a taxonomy at Climate Bonds Initiative to provide detailed guidance for the green bond market. We're kind of the global NGO for green bonds many years ago. It's kind of worked. When the Chinese adopted our recommendations in 2014 to set up a green bond market, they also adopted our recommendation to set up a taxonomy called the Green Produce Catalogue. That has guided development of the green bond market in China, now the world's largest, ever since. It's especially important if you're going to be thinking about incentives. So in the Chinese situation, they have a whole series of incentives, including discount capital at the liquidity lending window of the central bank if you post green bonds as collateral. Now, I know Nedbank would really like that. We're in Europe in the middle of discussing incentives now. Risk weighting differential and the capital ratio requirements of banks, for example, has already been introduced by the Hungarian central bank. And the European Commission has been actively speaking about it for the last 18 months. We will see those. Now that requires, to make that work, you've got to have a very clear definitional universe. You can't have the very high level principles of the ICMA green bond principles, which all fit on a page. You've got to know, how do you judge whether that building is green? Not a general concept like, well, energy efficient buildings, because then you're just creating loopholes, scam opportunities, if you like. And that's been the driver of it. The green bond market continues to grow. It's been the fastest growing asset class on the planet. And I want to mention the role of IFC in 2013, who issued the first 2 benchmark sized bonds and kickstarted the corporate and banking side of this. And they've been our partners ever since on many activities. So great to be here with them today. If I can mention a couple of the reasons why people are doing it. There is a pricing benefit, and Steve, you asked me to talk about price. Issuers we speak to around the world, even when they're getting price benefit, say that they're not doing it for the price. I mean, I believe them. I could be skeptical. They're doing it because of the nature of investor engagement. Because we now have a wall of money globally that's anxious about climate risk and policy transition risk. The electric vehicle situation in China, a policy to grow electric vehicles is going to lead to a wholesale collapse of the oil industry over the next 5 to 10 years, as an example. This has already happened in the utility sector, where utilities in Europe that didn't make the transition to renewables have seen their capital value drop to half of what it was a few years ago. Those that did make the transition, like Ørsted in Denmark, have seen their capital value on the stock market increase faster than the S&P. This is a kind of theme. So investors are clued up to this now. The way this works is that if an investor, an issuer, issues a green bond in Europe, they get a stock price bounce now. That is a halo effect because investors are using green bonds as signaling, as a way of identifying those organizations that are ahead of the coming transition risks. And this is the case around the world. We have a second thing happening in green bonds. In liquid currencies, and this is not in South African rand yet, but certainly in hard currencies and a couple of smaller currencies like Chilean pesos, we see secondary market trading is very strong. And in downturns, green bonds hold their value, which means they become a premium product. You know, Larry Fink once said that he didn't make money at BlackRock by giving people yield. He made money by making sure they never lost their money. In the bond market, defensiveness is all. So the fact that these bonds hold their value in downturns is really making them like gold dust and driving secondary market performance, which is driving primary price. So as a result, you get a lot of reports of price benefit, even though the Treasury is not doing it for the price benefit. We see 5 to 15 to, at the extreme, 100 basis points for a green bond in China recently, which came in 100 basis points below the central bank's benchmark rate at least. It varies upon rating and currency, of course. There's a big difference. Currency is a big issue for us because in this world of low interest rates, the tools that central banks have to manage the economy are reduced. They can't lower interest rates so far anymore, as the Japanese central bank has shown over the last 10 years. It doesn't, there's a point at which it doesn't make any difference. Now, the corollary of that is that means that economies adjust themselves with more currency fluctuation. We can expect higher levels of volatility going forward. That does mean we've really got to focus on domestic currency issuance if we're going to avoid flow on volatility to capital market players. Luckily, we have a lot of investors at the moment, and on my call this morning, I had PGGM and State Street Global saying they now have appetite, strong appetite for green bond issuance in local currencies like Indonesian rupiah and South African rand, which just wasn't there a couple of years ago. So there's a lot of reasons you might do this. Pricing is there, access to investors is there, including access to investors when frankly you're otherwise not going to get it. Let me talk about Eskom. There is no way in hell Eskom is going to be able to place a bond at any kind of passable rate in the foreseeable future, given its balance sheet. But when I was speaking to the Russian Development Bank and Ministry of Finance a couple of weeks ago, who were developing a green bond taxonomy, we had Russian Railways on the call who said they got the cheapest prices ever in Europe for their Russian certified climate bonds for Russian railways, when otherwise they probably wouldn't get take up at all. So I'm going to say to Eskom, I hope you're on the call. If you can get together to do a green transition bond, you will find investors at whatever risk profile you go to the market from. Without that, you may not find them at all. So access to investor base is really important. And I'm very happy to do introductions should we get to that particular point. Let me take you quickly now through a couple more slides. Next slide, please, if I may, Rachel. This has spawned a broader market. So on the back of the green bonds market, we now have other thematic markets copying it. Social, sustainable, COVID bonds, which is the next one. The green bond market started in sporting different kinds of areas. Started of energy, transport, water, all sorts of other things like ICT are now part of this, thanks to taxonomy development. Next slide, please. But this year, it's been social and COVID bonds that have taken off. Next slide, please. All these slides will be shared to you afterwards, of course. Now, we've seen that while green bonds were depressed in February and March, social bonds took off. COVID bonds, pandemic bonds, have seen 700 issuers in the market in the last 3 months. It's a vast pipeline. A lot of them in China, but we've also seen the Austrian Treasury issue a COVID bond. Now, when I've spoken to treasurers, they're nervous about the fragmentation of thematic markets. And I'm saying to them, we need to understand that this is all the same thing. Because when we're looking at dealing with the pandemic and at recovery, it is about dealing with climate resilience because our economies have to be resilient. And we need to be judging the quality of this issuance and the quality of the use of proceeds against that concept. Doing a recovery bond for oil and gas is not really a sensible idea because you're building backwards into a backward economy. You're not looking forward. Building a recovery bond for health or for clean energy, that's a different matter. That qualifies. This is the discussion we're in the middle of having now. We do expect to see, to comment on Sarah and Steve's reports, a unified market going forward. If you look at the SDGs, they're essentially, or can be seen as indicators of economic, social, and ecosystem resilience, climate resilience. We did some work on the European Union high-level expert group a couple of years ago. We're going to do more work in the coming year on knitting all this together. So South Africa can issue SDG, come climate, come resilience, come recovery bonds into one liquid market and avoid illiquidity premiums, which is very important, rather than having a fragmented program. Next slide, please. It is pretty exciting for issuance in the sovereign market. Netherlands, when they issued their green tap a couple of weeks ago, placed 1.4 billion euros within 4 minutes. And they closed the window because they had too much. The French did the same thing the week after. The Indonesians, with their 750 million pandemic bond, were 7.5 times oversubscribed. And then they did a tap on the green sukuk the week after, similar. This will be something we can use to establish funds. Cyril Ramaphosa has been talking about a just transition fund in South Africa. If we can identify a way of getting a return as to cover it, the fund will be able to be funded with green, recovery, just transition bonds, probably backed by an international MDB, to be able to create a larger pool that can dole out to smaller parties. These are exactly the things we're discussing in ASEAN at the moment, where we've already seen the setup of a series of these funds, and we need to see this in Southern Africa. Next slide, please. There are many ways we can tap this interest from international bodies. The standards have gone global. I've mentioned China, I've mentioned Europe, and so on. Of course, we've got to have the Johannesburg green bond listings for some time. Climate bonds has been part of working in nearly all of these countries, if not all, I think, at various levels. But the next slide, let me take you to that one. Taxonomies have also gone global. And click once more through, please. We've seen, I've mentioned China, I've mentioned Europe. We've seen taxonomy, just stay on this one for a minute, please. Taxonomy development in Chile, Colombia are underway. In Chile, we've said to them, they've said to us, we want to be able to raise money in the European market. So harmonization with the European criteria are very important. And remember that the taxonomy in Europe, that again, we've been central to developing with the European Investment Bank for the last 3 months, is going to govern investor reporting, corporate reporting, bank reporting, as well as green bond markets, as well as fund management, as well as member state reporting. It's going to be a universal tool to what you can call sustainable in Europe. So if Chileans want to raise money in the European market, they're going to have to meet it. Same thing in Colombia. So Colombia, the Hacienda has said, Ministry of Finance, we want our taxonomy that we're working on with IFC at the moment to be able to meet the European requirements and then to be further developed in areas that are of particular importance to Colombia, of which there are many, particularly in land use. In Chile, what we've put to them is they need to be doing work on mining, strategically important minerals for the transition to a low carbon economy and a resilient economy. Europe hasn't done this. Sort of on the agenda next year, possibly year after. I've also suggested to the Chileans, let's make this international. Let's invite the South African Treasury into the discussion now and have a collaboration, bringing the Europeans in to observe and to participate so we get global acceptance of these rule sets early. So we minimize roadblocks between different economies for the flow of green and sustainable capital. I think this is very viable to do and is critically important given Steve's slide about the extent of exposure to mineral resources of the South African economy. And this is the case in the Canadian economy and the Australian economy as well. And the Russian economy, by the way. And I've had the same discussion with them going forward there. In fact, Europe has set up a thing called the International Platform for Sustainable Finance, which is an association of 14 countries around the world at the moment working on sustainable finance measures, harmonization of taxonomies. A little earlier today, I had another call kickstarting our China-Europe harmonization project between the Central Bank of China and the European Commission. We're moving towards a joint taxonomy starting in September at the first meeting of this year of the International Panel on Sustainable Finance. South Africa is invited to join that coalition. Just to be very clear to you, we want South Africa in that coalition, working with our other partners, which includes India, it includes Chile, Colombia, and Indonesia, and Singapore, for example. Next slide, please. A little bit of detail on taxonomy, if I can. The European taxonomy has got some interesting features in it. Whilst it's a creature of a larger plan, a European action plan on sustainable financing growth, and I've mentioned a few parties recently, I won't go into this detail, but there's a lot of stuff happening in Europe to mobilize sustainable finance. Next slide, please. The foundation of all of this is the taxonomy work that we're doing. This taxonomy work, as I said, covers all sectors. Its concept is absolute measures that are science-based. We've made some mistakes over the last 30 years, and we made some mistakes in China, the Green Produce Catalogue, that we didn't listen adequately to the scientists. And as a result, our concept of what sustainable objectives need to be was not ambitious enough. That's why they're in this mess this year, where emissions have been going up for the last 30 years. In fact, we put more emissions to the atmosphere in the last 30 years than the previous 100 years. And our emissions reductions rate is so steep as a result, 50% cut in 10 years. So the European taxonomy is resolutely science-based, and policy is now catching up to it. DG Energy, the Ministry of Energy for Commission, is now having to reconceive or remanage its energy plans to take into account some of the critical measures. Next slide, please. So the feature of this taxonomy is threefold. Substantial contribution to achieving the 6 objectives, with climate mitigation adaptation, as Steve pointed out, being the first ones we're doing. We've added in this idea of do no significant harm. If you're building a solar farm, you can't put it in a wetland. It's kind of common sense, but we need to make it obvious. There's a whole bunch of stuff. If you're building a rail line, low carbon transport, you can't be transporting tar sands on that because you're doing harm off that, etc. We've also added in some minimal social safeguards, i.e. we expect adherence to the International Labour Organization Charter of Labour Rights and to the OECD's Human Rights Protocol for Corporations. That's it. There may be more on that going forward, but the critical thing is to get the environmental aspects going forward first. Next 2 slides are my key slides. In the next slide, I've talked about 4 layers of content. First, in the European process and in all the taxonomies we are working in around the world. We've got low carbon and enabling investments, manufacturing of components. That's where mining comes in. It's not to do with the processes of how you mine. That's got to be picked up. We need sensible environmental practices. It's to do with the extent to which the extraction of resources is critical as an enabling investment for the low carbon economy. We've then got a big discussion around transition investments. This is steel industry, very dirty, very high carbon, has got to become zero net carbon. We think we can get there globally in 15 years, not in 30 or 40 years. And ditto sectors like plastics or cement. Cement is worth 7% of global emissions. And yet there are cement products around that are 80 to 90% lower emissions for the same price. We think we can achieve the changes very quickly. And that's what the transition sector is about. You'll see a lot more discussion about this as the year goes on, and we're very keen to be able to engage with this project going forward. Adaptation and resilience. It is already 1.4 degrees. We've got to get used to a certain level of climate impacts. Droughts, storms, floods, fires are going to become the norm. So what does that mean for infrastructure hardening? But also, going back to my original point, in the middle of this COVID crisis, what does it mean for economic, social, and ecosystem resilience? This is the learning of 2020 that we have to get through our pretty thick skulls, I'm going to tell you, because we have been talking about this for 30 years. Now we have no choice but to grapple with this. What the opportunity is that we'll see SDGs as a universe of investments that we can pursue in this area. And we need to flesh out what that means in terms of taxonomy going forward. In Africa, we expect the green and thematic bond market to be dominated by SDG bonds going forward. Next slide, please. There's a series of things we've done in the EU taxonomy. I'm not going to go into the detail. These are some flavors. But as example of channeling the science, and this is channeling the International Energy Agency's Paris Agreement modeling as well. They came out and said, for the World Energy Outlook in 2018, that if we are to meet the Paris Agreement requirements, there can be no new fossil fuel investments that are unabated without carbon capture and sequestration. Whoa! I mean, how long have we been told that gas is a transition investment, including in South Africa, where you have new gas finds? The whole Israeli climate change plan is predicated on shutting down coal and replacing it with gas. And the scientists are telling us that's no longer the case. That's exactly right. They are telling us it's no longer the case. That window has closed. So in Europe, we've adopted a sustainable taxonomy which has a tough threshold of 100 grams of CO2 equivalent per kilowatt hour. It's technology neutral. You can get gas in there, but you've got to get it below that threshold, which requires you essentially to have carbon capture and sequestration. Without that, it doesn't cut the mustard. But of course, a whole lot of other stuff too. So that's the most challenging thing coming out of the taxonomy work we've done in the last 20 months. And I'm going to say is deeply challenging for the energy policy of every country we work in. But it is time to channel the scientists, as distinct from saying, yeah, we'll get there. We've just got a few difficult things in the meantime, and in 10 years, we'll do what you scientists are saying. We just don't have the time anymore. And there are many other sectors in this. Next slide, please, if I may. In the process we've used in other countries, we've started, let's take what we're doing in Colombia with IFC. We're taking what's in the European taxonomy, which is going to fly in Colombia, judgment call, doing a draft and saying, here's a draft. Local experts, just check that we haven't missed something. Then we've taken a bunch of areas which are not covered in the EU taxonomy, or where the EU taxonomy is very EU-centric. And we're saying we've got to do work in these areas. Mining is an example. And there we're bringing together domain experts who will then work on coming up with draft criteria. Because access to international capital markets is a critical factor for pretty well every economy, including the Chinese, who've just updated their taxonomy to exclude fossil fuels because they want to remove speed bumps for investment from Japan and Europe. The consultation with other parties internationally to make sure we're not going to have those speed bumps would be incredibly useful to build into the process. This is where the International Platform on Sustainable Finance that I mentioned earlier could be very useful if we can get South Africa to join. Next slide, please. To finish up, where are we going with this? Well, there is that international collaboration aspect I mentioned. Most of the big investors that are keen are European, US, Canadian, Australian, and Japanese. GPIF, the largest pension fund in the world, has a strong green bonds commitment. They've gone from $0 to $3 billion worth of green bonds in 12 months. And they've tasked their fund managers, BlackRock and State Street, with a big climate change plan. This is an opportunity. If we can construct investments that meet their interests, their needs, noting all the things I mentioned earlier, we can tap that money. We, of course, from a local perspective, need to be thinking about jobs, 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 and jobs. We can do this with green. We can do this with building investments, getting energy efficiency measures out there, with environmental restoration and afforestation, with distributed solar, which creates a lot more jobs than in large-scale energy generation. And of course, bearing in mind the just transition theme that has to be a part of this going forward. We do need to institutionalize concepts of resilience, and the taxonomy is where we can start that discussion. But it will take time for some of these, because we've got to know what social resilience measures are, not just infrastructure resilience and agricultural resilience, which are the starting points. There's lots of scope for sovereign bond issuance out of this, recovery and resilience bonds. You will need to report to your investors once a year that the money really is going to where it's said it's going. When Johannesburg did their green bond a few years ago, at the end of the 12 months, this was challenging because they didn't have their system set up properly internally. They fixed them, working with Standard Bank and ERM. We need to get this right up front, otherwise we're going to hit a speed bump, if you like, or a pothole in a year's time. But we can do this. And if anywhere in the world can do this, it's South Africa, who actually was doing green bonds many years ago. I note Nedbank in particular had done some work in this area. But there's lots of other scope for issuance too. State-owned enterprises, Eskom, remember what I said, setting up special funds like just transition funds, corporates who can do this, especially corporates who might like a stock price bounce, the Anglo-Americans of the world with the mining ones. There's a lot we can do here. We, of course, have to be mindful of debt loads and debt ceilings. We need to be thinking about promoting local currency issuance to avoid that FX volatility. There's a lot of complexity, but the main thing I can tell you is the money's there. There is a wall of money looking for this sort of stuff. It wants green, and it'll choose green over other opportunities, given half a chance. We just have to make it easy for them. Thank you.
Thank you very much. Super. Thank you very much, Sean, for that extremely rich presentation, and I know that there's a lot there that people might want to respond to, and I'm not going to take too much time, but I'd like to invite Steve and our expert discussants just to come on board and perhaps also share their thoughts on what you've reflected, and also on what we feel could take us forward as a country and really benefiting from those opportunities you've highlighted. So if I may please invite Shamila and Jolly and Barit, please join Steve, and just to hear your insights as well. Thank you.
Thanks. So thanks, Sean. Thanks, everyone. I think we are going to run a little bit over time, so my apologies in advance for that, but I think it's been a fantastic conversation so far. I love Sean's metaphors of there being a wall of money out there that appeals to the capitalist in me anyway. But I think there are a couple of key things that we want to be able to respond to. So I'm going to give each of the discussants a chance just to respond from their perspective to all of the things that have been shared so far, and then we will have a short discussion. I think there are probably too many people to ask questions via voice, so if you can drop your questions into the chat, and we may not get to all of them today, but we will go through the questions afterwards and collate some responses for you, and ask our panel if they can assist us with that later on. So I think I'll ask Shamila, if you wouldn't mind stepping in and giving a little bit of a South African perspective and some of the activities that the JSE have been doing in this bond space, which are quite significant.
Thank you, Steve. So in the bond space, I think Sean has done all the groundwork for me. There's not that much left for me to do, but to give you the perspective on where the stock exchange has come from. So take a small step back, really, if you think about the fundamental value an exchange brings into any market, it's this function of aiding the capital allocation function and creating that marketplace which ultimately supports the economy. So then if you look at that, the way in which that money is allocated and what we put in place to allocate it actually potentially has a massive multiplier effect. And so in that regard is where the JSE started looking at sustainable finance instruments, and bonds were obviously the natural one, given that green bonds already globally had started growing. We saw the need in the context of our own economy, obviously, for these kinds of instruments. When we talk about taxonomy development as well, including things like the green bond frameworks and the taxonomies that support them, they're often developed in perhaps two distinct ways. The one way is where they led at the national level, which is what we're sort of seeing now with the taxonomy work and the sustainable finance paper from Treasury. And the other one is where sort of more on the private market side, the lead is taken. And that's where the JSE started from in 2017. So the green bond segment went live in 2017. It references the ICMA principles and the green bond standards as being what an issuer would need to look to. And Steve, this incorporates a very important principle, which is this issue that's come up a few times on the call, the level of international alignment and what we look at. So it's very important that we always keep our mind on what's going on internationally as a reference point. The EU taxonomy was referenced, and there are huge extraterritorial implications for something like that. And you yourself have mentioned that in relation to what that means for the economy, what that means for exports, trade exposed sectors and the like. So we started with looking at where can we get that financing. We realized there's a significant amount of international investors who are interested in the South African market, and how do we make instruments attractive both for them, but also to leverage institutional money, which is there and which is looking for credible, sustainable investment options. So the green bond segment went live. It has been successful in our estimation, with one municipal bond listing and various tranches of corporate bond issuances from various sectors as well. And we are just about to go live now. We've been given the regulator approval for our sustainability segment, which is an expansion of that green segment to now include social bonds and sustainability bonds. So by providing this regulated space with a reference point, it allows for investors to have credible options, which they know are in a regulated world-class marketplace. And so we see ourselves as helping to create that enabling environment for this capital flow to happen. Thank you.
Yeah, brilliant. Yeah, thanks for getting out ahead of the curve there and creating some infrastructure for us. I'm going to ask Jolly to come in. I'm particularly interested in the perspective of asset owners. So when I talk to asset managers, they tell me, well, the mandate's not there, and kind of retreat into traditional practices. So it'd be great to get your impression on that, but also I'm very interested in your view on the integration of social aspects into how we think about this process. Thanks, Jolie.
Thanks, Steve, and afternoon to everyone. I am quite fascinated at the moment by the conversation in the market around the possible role of retirement funds can play in rebuilding the economy during and post-COVID, and it's happening in various areas, not just in the green sectors of the economy. So firstly, let me say retirement funds do not really have a choice but to consider issues of sustainability and climate change if we are to do justice to our mandate that requires us to meet the reasonable benefit expectations of our members. In South Africa, this mandate is even more urgent when you consider a safety net that cannot cater for every need of every citizen, and unequal society with an undesirable Gini coefficient, the issue of jobs and food security exposed by this pandemic and general lack of investment in our labor sending areas, those predominantly being rural and peri-urban parts of the country. So retirement fund trustees need to balance this with the tension of improved life expectancy of our members and the hope that many members that they will live their pre and post-retirement years in a part of the country that is both pleasant and not underserviced by government and the private sector. So students of economics and business hold this fundamental belief that where there is inefficiency, there is a business opportunity. And of course, that means an investment opportunity. But balancing this with the fine thread that is risk and reward. So traditionally, the difficulty for retirement funds has been packaging of these opportunities in a way that meets our investment criteria, regulatory requirements, and serves to improve the lives of our members more directly and tangibly. In all of this, we must not forget that the average retirement fund in South Africa has less than R1 billion in assets. That applies to more than 80% of the industry. So the scale and patient capital requirements required to execute many early stage green investments is not one that many individual retirement funds have, but this is not a problem with no solution. You know, there is the call nearly, or a desire from the industry for competent investment consultants and investment managers that play a key role in how these investments are pooled and presented. And these opportunities are basically packaged for retirement funds, keeping in mind the reality that we face in retirement funds, which is greenwashing. That's also something that is quite serious for us and quite prevalent, you know. So what excites us about this taxonomy is that it is critical for retirement funds. It is a tool that allows us to define, to measure the extent to which we are meeting the mandate of our members, whilst playing a role in ensuring that South Africa is a country that we want to live and retire in the long term.
Brilliant, thanks. I mean, I'm particularly interested, I mean, I guess maybe to see if you agree. I mean, one of the things that we are worried about in the sort of asset management, asset ownership space is instead of investing in green, we're seeing at least the risk of South African pension funds and other retirement investment funds buying up stranded assets that are being sold by potentially far-thinking corporates like in coal and potentially other sectors. Is that something that is being discussed within the asset management circle? And will the taxonomy help sort of prevent that? Jolie, I think you're still muted. There you go.
So I think that a taxonomy, along with some of the regulation that is proposed in the paper that was released by National Treasury will help retirement fund trustees go a long way towards not taking up those assets or those assets that basically go contrary to what we're trying to achieve. And part of the problem that we face as asset owners is that we have given third parties the mandate of doing all the research and making proposals to us around this. That is why the JSE and its standards are so important for institutions like us. The further removed you are from what is happening operationally, the bigger the chance of greenwashing, the bigger the chance of us picking up those stranded assets, the bigger the chance of those risks that we're trying to mitigate against having a head-on collision with basically our investment strategy, if I could put it that way. Yeah. So with things like taxonomies coming out and with National Treasury stepping in and the regulator stepping in our industry to define things, it kind of puts a safety net for us as institutional investors on the bottom end. And we can say, oh, this is our cutoff point for this thing. And this is what we need to do. And that is why I'm excited by the presence of the regulator in these discussions, because it helps bring a party that has a bigger bark than particularly some of the smaller funds in this industry, because assets do matter, size does matter.
Very interesting, thanks. So I'm gonna ask Barrett for your insights, given your international experience and the experience of the IFC, for your views on what's been said so far. But I'm also interested in your thoughts about, does a taxonomy like this apply only to bonds, or does it have a broader scope within other financial instruments?
Okay, thank you. So let me just start by talking a little about IFC's work in developing the market infrastructure for sustainable finance. And then let me come back to the taxonomy at the end. And if I forget, remind me. So many of you will know IFC as a green bond issuer, and we've been in the market since 2010. But may be less familiar with IFC actually having developed a one-stop shop, offering a holistic approach to the development of the green bond market. So IFC is also an investor in green bonds, where we can be an anchor investment. We can also provide credit enhancement that will get the issuer a better price in the market. IFC, as part of an investor, have mobilized private capital, getting institutional investors to invest alongside IFC, investing in green bonds in emerging markets. And I'm sure you have heard of the Amundi Ego Fund. You may also have heard of HSBC's Regio Fund, which is investing in green bond issued by real sectors. And then, of course, there is what has been alluded to throughout the conversation so far, IFC's role as an advisor, sharing our green bond expertise and support of financial sector and capital market regulators and industry association in emerging markets to develop green bond frameworks and catalyze local issuances. And a part of that is also the technical assistance program, which is providing training and an advisory service. Green bond has been a game changer. It has mainstreamed sustainable finance. It often asks if it has provided additionality, if it actually had raised funding for projects that wouldn't have been funded anyway, and maybe not, but it had definitely changed the mindset of investors, and investors are now way more tuned into impact. I will now go into details around the funding need and the resilience of the financial systems, which has already been brought forward. But I will mention a couple other trends in the market that are bringing this together, namely the task force on climate-related financial disclosure, which is helping investors to see the climate risk of their portfolio and actually shift their money accordingly. And the other one is the Network for Greening the Financial System, which is a group of central banks and supervisors that are thinking about what are the recommendations for the regulator's role in providing guidance to the market on climate risk management and sustainability. Sean has already mentioned how the green bond has spawned new innovative sustainable finance solutions like the social bond, the sustainability bond, and more recently we saw the sustainability linked bond come out from IGMA. It also inspired the loan market with the green loan and the sustainability linked loan. So the sustainability linked bond is one of the more sophisticated new structures, and unlike the green bond, it's a general purpose bond. That means that the proceeds are not earmarked, and as is the case with the green bond. The cornerstone is, however, that the bond's financial and/or structural characteristics will be linked to the sustainability commitments and performance of the issuer, and thereby holding the issuer responsible. My final point will be, this is the moment to seize the opportunities of building back. It will be short-sighted not to seize the opportunity and incorporate sustainability and climate resilience into the recovery packages. There is limited public funding available, and I'm sure that officials or governments will have to cater to investors increasing looking for impact, and this is where the taxonomy comes into play. Europe has already announced that the deployment of the 750 billion euro recovery fund will be guided by the EU taxonomy. To your question on whether taxonomy works beyond the green, I think it does. I think you already have seen how the EU taxonomy have identified environmental objectives, but at the same time it has its social aspects that they need to test for the social value of it, and it has the do no significant harm. So it is not just on the individual sector, and it as it is envisioned in the European Sustainable Action Plan, it's going to be used across asset classes and across companies. So I hope I answered your question, otherwise you will have to ask me again.
Yeah, perfect, thank you. I mean, I guess I'm also interested, I mean, I hypothesized at the beginning that we'll start to see green criteria sort of find its way into traditional lending and other practices. Is this something that you're seeing? How rapidly do you think this will happen? Is this something that's a reality today, or is it 3 years or 10 years? What are you thinking on the kind of timing of the mainstreaming of this conversation?
We see it already in IFC. We definitely see that our clients are interested in green or sustainability, and they see it as a way to franchise their value and to communicate their sustainability strategy. And they're probably also responding or reacting to an increase in scrutiny by investors who wants to know how they manage and report on green and climate risks. Talking to financial institutions and corporates among our clients who have gone through the process of issuing a green bond, it's a common experience for them that they have gotten a way better understanding of their sustainability opportunities, but also the risk of their business model. And I think that have inspired a totally new approach to green and to sustainability.
And just one last question for you. I mean, Sean made this comment about Eskom, and they're more likely to be able to borrow in at better rates if they do it in the context of a green strategy. I mean, he used Eskom as an example, but you know, it applies to a range of sectors: steel, cement, mining. Do you think this is a reality? Is this something that we should all be thinking about much more carefully?
I think so. I also think that there is a confusion in the market, because we have seen a number of, should we just say, less green issuers come to the market, and where the market may, in some cases, have bumped their nose at them and said, you're not green enough to really do a green bond. And I think you have seen some issuers hesitate going into the green bond market for that reason. And maybe they have coined the bond by a different name, kind of alluding to that it probably has some green qualities, but at least there will not be there will be no finger pointing of them not being green enough. I think the EU taxonomy have kind of addressed it in allowing for transition under certain conditions and saying this is green. It may not be dark green, but it's light green, and these are the requirements we will have in order for us to consider it green. And that's already opening a door up for that you as an should we call it a brown institutional company still can be player in the green space.
Excellent, thank you. So obviously credibility of the market is really important. Shamila, if I can come back to you, I see you might have a comment on that in any case, but I also wanted to ask you, Sean referred to sort of halo effects in other markets. So people, issuing green bonds, getting a premium in their stock price. Is that something we're seeing in South Africa yet?
So that's a very interesting question, Steve. I made a note of that when Sean mentioned it, because I've heard of that, but we haven't actually backtested and seen if the same thing happened in our market. Mm-hmm. So I'll get back to you on that. It would be actually very interesting to see. I'll definitely have a look. And then on the points that we're making about whether a taxonomy has application only for bonds and, that sort of asset class, I wanted to point to actually a very practical and what I thought was a very innovative use of something akin to a taxonomy in the equity space. So the JSE works with a provider and a ESG rating company, which is FTSE Russell, and they have something called green revenues, and a green revenues model that they look at and start collecting data on companies using a classification of what is generated revenue in that company, mapping it back to something akin to an economy and saying that if you are generating revenue from certain types of activities, so a classification like a taxonomy is, then we're classifying those as green revenues. Once that threshold goes beyond a certain portion of their total revenue, then that company automatically is classified as a green company. So this goes a bit to the tagging and the benchmarking and all of that, and how we start seeing that. So in practice for an investor, for example, it starts becoming quite clear and easy once you start segmenting like that. How much is it actually generating from activities that are correlated or well correlated, or that are supporting a transition towards sustainable development, towards a greener economy? So those are other ways in which you could use the classification to drive different purposes, but again, completely aligned with this notion of reallocating capital and activity towards sustainable development. So that was the first one that I wanted to point to in relation to how one could use the taxonomy differently. And the other points left my mind completely. I'll get there just now. But that, I think, was to answer that immediate question on how else we could use a taxonomy. So that was innovative. Oh yes, Steve, the other point was on in relation to the EU process, and Barry touched on it a little bit now. I think it's very important that we are aware of what's happening. The JSE, for example, is part of the Global Investors for Sustainable Development Alliance, and we see our role very much as having to keep up with what's going on internationally and bringing that back to relevance to the local market, and then even making input in things like the taxonomy development process and supporting that in a way that we feel will be aligned with international developments. So there is a huge opportunity there for developing markets such as ours in particular, I think, to make input into the way that taxonomy is developed, the issues around transition, the green to brown classifications and the like, or at the very least to understand exactly what those implications might be for us. So that was just the follow on Barry's point. Thank you.
I'm conscious that we are running out of time, and so as loath as I am to cut this conversation short, because it's been fascinating and I would love to hear from everybody a lot more, I thought I would just quickly give each panelist a chance to sort of close for 2 or so minutes, and then we'll wrap up for everybody who's on the call. So Jolly, I'll turn to you first. Are there any closing comments you'd like to make?
I just want to close off with this, that green finance taxonomy helps us move the conversation away from the fringes of investment practices and mainstreams it, like Barry pointed out earlier. And once we have a sufficiently detailed taxonomy, we can then produce the tools that adequately measure our participation in the green economy. It also reduces for us a whole plethora of risks as institutional investors, and allows more and more participation. It's normalized, it's not taken out. And then once you normalize it in one asset class, there is then a bigger chance that it will be normalized across the board. And these then become part of the daily bread of the investment considerations made by our managers. And it's not just one or two people. And then I'd also like to say that one of the things that I've actually really been proud of is that some of our retirement funds in South Africa were direct early investors in the green economy through wind farms and the use and through solar farms that were put up in South Africa. And this is during a period when you couldn't even get onto a conference kind of breakaway session in investments because people really thought that you were a tree hugger and it was abnormal. So retirement funds are still and will always be there. It's at the different levels. And as we include things like taxonomy and we make things easier for funds, it then makes it easier for funds to become part of the nation building efforts without compromising our members' returns simultaneously. So if I could just close off with that.
Yeah, thanks very much. Berit, do you want to give us your closing comments? I think you're still on mute.
Yes. I think I would pull in some thoughts or some conclusions from an IFC research on the success of a sustainable finance strategy. It really hangs on the integrity and the transparency. And it's important that the existence and the quality of the sustainable finance policies and frameworks are in place. And it also depends on the state of the capital market development and the momentum, which we, for instance, have seen the green bond has sparked in many capital markets. And finally, the governance of the strategy is important. I think that would be my final comments.
Thank you. Shamila?
I think, thank you, Steve. So for me, it's very important that, I think the financial services ecosystem works together very closely on understanding this. There's the entire spectrum, within, for example, the investment value chain, you have the advisors, you have the asset managers, the asset owners, all of them together. And that view and that input has to happen for a taxonomy to be fit for purpose for our country, to lead us to this transition that we need to get through, and to ensure that, as Jolly so eloquently put it, that we have a future worth retiring into. And so that role is now. And I think for me, there's just a sense of urgency that we need to land quickly, and we need to build in those incentives very quickly, as well as the sort of guiding role that a taxonomy plays, and have that coherent approach. Else, we risk globally becoming, really pushed into oblivion almost, because we're working in a global economy. We are a part of that, and we have and it's a massive ask, but it's something we need to move quickly on. So for me, it's about that sense of urgency, a sense of coherence across that entire value chain, that, that it's understood across all of that. So there's a capacity building portion potentially as well. And that we need to encourage more of this and more, I think, open and honest conversations. Thank you.
Thank you. Thanks, everybody. I guess if I was to summarize the gist of the conversation today, climate change and environmental issues are increasingly part of economic recovery and economic competitiveness. And South Africa, being particularly vulnerable, has to start thinking about these transitions, and that these transitions are going to be more effective and more likely if they happen in the context of a green transition plan and a green transition narrative. And I think we've heard from all of the speakers that a credible, well-governed taxonomy is fundamental to underpinning how we talk about and how we organize and how we cohere around green stimulus. And so it's an exciting project. As I mentioned at the beginning, it requires everybody's cooperation, and I really thank Jolly, Berit and Shamila for their support both now, but also in the project in its entirety. And again, thanks to Sean and Sarah for opening for us. The MBI will send out a summary email after the event, give us a day or two with a few of the key points, but also with a link. So if you want to watch the video again or share it with a colleague, please do that. And then we will also have a short registration link that allows you to register as a stakeholder to the project if you want to be involved in any of the consultation workshops, or just even share with us some online support. Yeah, once again, thank you everybody for dialing in. It's been a very rich and fascinating conversation. Thank you again to all our speakers and our panelists. We really appreciate your support. And I hope everybody that you have a wonderful day and that this has been an interesting and stimulating event for you. Thanks very much. Thank you, everybody. We are now closed.